Hi, Zach. It's great to have you here at Arbo on our offices on Capitol Hill. Thanks for coming to this webinar about rate cases.
Yeah, thanks, Gary. It's great to be here. First time in DC. It's awesome how close you guys are to the Capitol. You can see it walking up to the office, so it's great to be here.
Good. We at Arbo love to get into the details of regulatory environment and its impacts on the energy business. Today we're going to talk about rate cases, and we do that quite often with our shipper and pipeline customers, but I know East Daley has a unique perspective on the issue from the investor's angle and rolling up the impacts of regulatory events onto the entity and regional market levels. So why don't you give us a brief overview of the topics we'll cover today, Zach?
Yeah, so for me, the purpose of today is to inform anyone who might be affected by rate cases, from some of your clients to our clients. And even if you've never heard of a rate case, we want to cover everything from the entry level into the details so you can really understand after watching this, what goes into a rate case, what to watch out for, some of the timing behind it, and more importantly, how it might affect you depending on how you look at the rate case. So if you're a shipper or a pipeline or a investor in one of the companies or the debt on the pipe, we really want to inform you on what's important to watch out for. And I think you and we'll go in the details. We'll read the 100 to 1,000 page rate cases for you, and we're trying to explain that today and help you understand it a little bit better. Anything else you'd add there?
I think just a good point. It's a lot of detail. We're going to cover it at a pretty high level, and hopefully what we do as companies is help our clients understand a more synthesized version of it rather than they don't have to dive into all those details that we do.
Yep, and I know that, from our view, we cover midstream companies on an asset level, so a lot of our clients are investors in those companies, so that's how they look at these rate cases. But I know you guys have some more unique clients, such as the actual shippers and pipelines. Do you want to go into that a little bit?
Our client base is mainly pipelines and shippers. And for the pipelines, what they're looking at us to do for them is help them anticipate filings by their competitors, and also benchmark the other companies and their strategies for approaching rate cases and the results that they get in their rate cases. We dive even deeper with them typically on the testimony that gets filed and things like that so they can develop their own strategies. I'm sure your clients probably don't care about the testimony, but ours do. And then from a shipper perspective, it's really understanding out over the term of contracts that they may have with pipelines, either that they currently have or that they're anticipating signing, understanding whether that rate risk is upward or downward, so that they can both inform their negotiating strategy for the pipeline contract and also just understand what their cost structure may be going forward. So from the pipeline and shipper viewpoint, those are what they're really looking for. But I know East Daley has mainly the investor perspective in mind, so if you want to go into that and what they look for in a rate case.
Yeah, so I think you and I, start at the same point, and we just maybe end a little bit differently. East Daley, for those not familiar, we roll up every single asset a midstream company owns and operates to a cash flow level. So what we really highlight for our clients is, what companies have a lot of this interstate rate case risk. So today we'll use Kinder Morgan as an example throughout, but there's many companies we cover that have these pipelines and have this ongoing rate case risk. And I say risk because we really focus on rate cuts, what could affect the cash flow of the business. So for example, Kinder Morgan's interstate pipes, the pipes that could be affected by rate cases, make up 40% of the company's cash flow. So for an investor in Kinder Morgan, it's very important to pay attention to these pipelines, and it's also important to know which ones to pay attention to. Some of their pipes make up 0.01% of the cash flows. It might come out in the news, there's a rate case, we talk with clients and we say, hey, don't worry, even if this is a bad rate case, it's not going to affect the outlook of Kinder, and your investment, is relatively safe. And on the other side, like Tennessee Gas, it's one of their biggest assets, so when there's a rate case on that, we really spend a lot of time with our clients.
Right, and I guess that would be a difference too. For our shipper clients, the interest may be very acute depending on what pipeline they're shipping on. So even if it's a small roll-up for Kinder Morgan, it could be a major pipeline for a shipper. So
Your clients might have a different view and interest, yeah. Did you want to go into, starting off how these rates are kind of set and what you guys look at?
sure. So you'll probably hear the word a lot today, FERC. That's the Federal Energy Regulatory Commission. They're the agency that not only controls the rates that pipelines can charge, but they also control when and where they can build new capacity. Under the Natural Gas Act is what gives FERC the authority to regulate rates, and FERC is directed essentially to fix those rates at what is called a just and reasonable level. And those two things impact both the pipeline and the shippers. So it's reasonable, meaning the tariff is fair for a shipper to pay for, but it's just in the sense that it's enough to encourage the pipeline to invest the money needed to provide the services. So there's a tension there between just and reasonable, and FERC is trying to balance those two directives, I guess. There are two sections of the Natural Gas Act under which rates are set, and you'll hear people refer to the rate cases based on the section of the Natural Gas Act under which the rates are set. So that Section 4 is a rate setting that the pipelines file, and they seek to typically increase their rates by filing a Section 4. So from a perspective of an investor, that's a good thing. They're raising their rates. They're going to raise their income. A Section 5 is filed by either FERC or the pipeline shippers, and therefore it is typically trying to lower the rates. And so to your point, that's a rate risk, because if they're subjected to a Section 5, there's a chance that their revenue may decrease. So that would be a bad thing for a public company. The way FERC sets these rates is they essentially do it on what's called a cost of service basis. And so they calculate what the costs are that are necessary for the pipeline to provide the service, and then make sure that the rates are set to equal that cost of service. That may sound like the pipelines are doing it for free and not having any profit, but the part of the cost of service is a return on the assets they have. And that's one of the two main elements that we'll focus on today that FERC includes in the cost of service, which is depreciation, which is the amount of money they need to recover in their costs for these assets as they get used up, essentially, and then a return on those assets. And that is really composed of two components, equity and then the debt. And there's typically a fight over the percentage split between equity and the debt, with pipelines trying to drive the equity percentage higher because that means they get more profit, and shippers and FERC trying to drive it lower. FERC tries to keep the equity split no more than 50-50. Pipelines try to drive it as high as 70-30. And then on that portion that is equity, they get a return on equity. And that is probably the second most contentious part, is what is the market rate? What is the market demanding? What are your investor customers demanding from the pipeline in order to invest in them? Typically, in the cases that have been filed recently, what the pipelines are asking for is somewhere between 14 and 16% on the assets they have invested. So the purpose of the rate case, either a Section 4 or a Section 5, is primarily focused on just one portion generally of the pipeline's overall tariff, and that is what we would refer to as the non-incremental pipeline tariff. And that is, if a pipeline has gone through a lot of projects recently, most of those projects will be separately priced on an incremental basis, and those sort of ride through the rate case. What doesn't ride through is the historically traditional pipeline and the historically traditional shippers. And that is what the rate case will be focused on, is what is the rate those shippers are paying. So that's how we look at sort of just the overall flow of a rate case. Zach, now I think you want to assess how the risk, how East Daley looks at the risk of a rate change as you described earlier.
We start out with the return on equity, which you mentioned, and we identify any pipelines that the company owns that has an ROE over 20%, call it. Now, you can get rate cased below that, you can get a Section 5, but we start at that 20% mark. So that really identifies, who is at risk of potentially having a rate case. After that, what we look at is, does the pipeline have a moratorium? So a moratorium, and we'll get into this a little bit later on, but moratoriums are basically neither the shipper or the pipeline can file a rate case. It basically protects the pipe from any downside or upside during that period. The last one we really look at is a comeback provision. So a comeback provision basically requires the pipe at some point to file a rate case. So when going through all of these, we identify, is the pipe over earning? Okay, it is. Is it protected? Okay, it actually is. And when does that protection roll off, and when do they have to file a new rate case? This allows us to call out to clients that, hey, in 2024, watch out for this pipe and watch out for this downside or potentially upside in your models when you're evaluating your investment. The last piece of every pipe that's really important to look at is negotiated rates. So negotiated rates are rates struck between the shipper and the pipeline. It's a contract. FERC generally will not touch this when they go into a rate case. So at a high level, what's important to look for is the higher negotiated revenue you have, so the higher percent of those negotiated contracts you have on a pipe, from our point of view, the more protected you are. So if you have 100% negotiated rates, well, one, you probably won't have a rate case, and two, if you do, it shouldn't affect your revenue at all. And that's obviously a drastic example, but it is something that we look for. So a lot of times if there's a rate case that comes on a pipe, our investors call and say, hey, what does this mean? And a lot of times we come back and say, hey, they have 70% negotiated revenue. Worst case scenario, it's an XYZ revenue downside. So that's really high level what we start with. And then of course we can dive deeper into the actual details of the rate case with the client if they want to go down that road.
Yeah, I guess we're sort of a little different. We look at the sort of Goldilocks range of when a pipeline needs to be earning an ROE somewhere between 10 and 14%. Mm-hmm. It's not painful enough, it's not under earning enough that they would be interested in going through the pain of filing a rate case. Yep. And 14% isn't high enough that it subjects them to a risk. Beyond that sort of range, then you sort of start getting in, like you said, there's a debate as to what above 14% subjects them to a risk. We probably think it's more like in the 16 to 18% range, but yeah. Certainly once you're at 20%, you're at that point. Yeah. And below 10%, to be quite honest, then the pipeline's got to be thinking about, is it worth the pain of filing a rate case in order to get that ROE back up? So
absolutely. And one thing I didn't mention too is, you guys look at negotiated revenue as well. There's also discounted revenue on top of max tariff revenue. So for people that haven't as much experience here, could you kind of touch on the discounted side? Because it gets a little confusing there.
Yeah, a pipeline can charge the tariff rate and they can give a discount off that tariff rate. And a discount is what it sounds like. It is lower than the tariff rate and it has to remain lower than the tariff rate. So that type of contract can be impacted by a rate case because if it's discounted but can never be higher than the tariff rate, if the tariff rate gets reduced, those discount contracts have to come down to the max tariff rate. A negotiated rate is a little different. It can be either higher or lower than the tariff rate, and people often ask, why would anybody agree to pay more than the maximum that a pipeline can charge? There are a number of answers for that. One of the most common reasons is, as we discussed, as a pipeline builds projects out and expands its capacity, it does that typically on what's called an incremental basis, meaning in order to protect its traditional shippers from any cost increases from that expansion, they agree that they will keep costs and revenues separate from that, separately accounted for in their books. And only those shippers that are using that new capacity pay for that new asset that's being built. They typically want a negotiated rate that will stay the same throughout the either 10, 15, 20 years that the pipeline wants in order to recover its costs. And so what happens is at the beginning of that 10, 15, 20-year period, the rate they're charging is typically lower than what would be a tariff rate. But by the end of that contract term, it's much higher than what would be the tariff rate on that project. But over the course of the term, they essentially pay some type of levelized rate sufficient to get the project built. So that's one reason a negotiated rate contract could be signed, and that is probably the lion's share of what negotiated rate revenue is. There are some other types, an index-based rate. So if there's, and you guys do this a lot at East Daley, track the difference between the basin differentials. If there's a huge basin differential, and my pipeline runs from the low-cost basin to the high-cost demand center, I may agree with a shipper that I will charge them a lower fixed fee and then have a much higher commodity fee, it's called, if they actually use the capacity and make a profit. But then they share that profit with me. And so if they're doing that, that means they may pay more than the max tariff, and that would be a negotiated rate contract as well. And then the final one is, again, to avoid rate risk, either the pipeline or the shipper may want to enter in a negotiated rate agreement and say, no matter what you do to your rates, my rate's going to stay this. And so for the pipeline, that may happen if they think they're about to get Section 5'd. And their rates are going down. They may want to force their shippers to sign a negotiated rate agreement. For the shipper, it may be if they're looking at a pipeline that may be raising its rates shortly, they would want a negotiated rate to know that it stays the same.
Yeah, and I know yesterday we were just chatting, and you said it's a pretty good indicator when a pipeline starts signing a bunch of negotiated contracts that they might think a rate case is coming, and it's going to be negative. So you guys, for your clients, you watch out for that, and you say, hey, maybe don't, if you're a shipper, maybe don't sign this depending on what you guys think the rate case is going to do, because if you sign that for 5 years and then they have a rate case cuts the rates 20%, you're gonna be paying 20% higher. So I thought that was interesting.
Yeah. So now that we've got that as a backdrop, Zach, can you walk us through the Kinder Morgan, which you said we'd use as our example here today?
Yeah, absolutely. So one chart we kind of send to clients is just a high-level overview of the company's most important assets that might have rate cases coming up. So Kinder Morgan, we'll always have a handful of pipes going through rate cases. So what we highlight is kind of what we talked about earlier. When their moratoriums are, when their next rate case is, based on comeback provisions or moratoriums rolling off. So if they don't have the requirement to file a rate case, but their ROE is extremely high, we'll call out risk and say, hey, when this moratorium ends, the protection period, they're likely going to get Section 5, and there will be risk. The last category we show is the max tariff percent. So we highlight what percent of the revenue is at risk. A lot of the times we do bucket discounted and negotiated together, which is a little different methodology than you guys use. And that's due to the reason that you touched on. If you have a rate here and then it comes down past there, those discounted revenue rates will also be affected. And then we keep a highlighted status of the current settlement. So is it ongoing right now? Did they settle? What are the rate cuts? So when we really look at Kinder Morgan, they continue to have rate cases. So we just like to keep clients informed on what's going to happen in the next year. I will say Kinder Morgan's gotten really good with transparency. They put this in their investor deck, which is great for us. They show all of their assets. They show all of the rate cases coming up. So for clients, they really call us and say, hey, I saw they have a rate case. What's the revenue downside? And that's one thing that we do is we roll up all of the revenue risk for all of the assets to give the client, because Kinder makes billions of dollars. So looking at one pipe, you're like, that doesn't affect the investment. But if they have 7 rate cases in the next year, then it starts to matter. And that's really what we focus on, is being able to identify, the assets, adding them up, and then letting investors know, hey, keep an eye out because it's a $100 million hit next year.
But again, they may have a pipeline that's under earning, and so that could offset with revenue increase as opposed to a revenue decrease. So
Yeah, exactly. We've seen that more and more. Columbia Gas was able to raise rates and things like that. So it is becoming more common with costs going up, and we'll jump into that a little bit on how we look at the costs. We'll focus today on El Paso. So when we're recording this, it's just ending its rate case. They filed the settlement in November, and they have to leave a period of time open for comments, but it appears that their settlement will go through. So one thing, focusing back on the ROE, when we look at El Paso's ROE over the years, it's trended to and then above 20%, and then in 2019 they actually had a rate case, so it comes back down. But even after that rate case, it's still above 20%. So there's a few dynamics that could be causing this, and we see this a lot. So for Kinder and for El Paso, that's great. They're still earning a 20% return on equity. You're happy if you're a pipeline doing that. We pull the rates for all of their categories that they charge, and when these rate cases happen, you can see the rates drop. What's interesting with El Paso is right after the rate case, their volumes went up. So, revenue is a pretty straightforward calculation, rate times volume. That really kept the ROE elevated, and that could be a few reasons. So 2019, for those that remember, Permian was pretty tight. El Paso gets you out of the Permian, so it was a very good pipe to be on. On top of, throughout the years, they've been doing compression projects on El Paso, and so like you mentioned, there could be a lot of this revenue, and there likely is a lot of this revenue that's negotiated at higher rates potentially than the discounted rates or other rates on the pipe. And those are all negotiated for new volumes to go from Permian to California. So that combined, although they cut rates, their max tariff percent is lower. So it might, going into the future, if those negotiated contracts stick on, you might stay higher than the typical 12 to 14%, which is great for El Paso. Right. So one last thing we look at is the costs and the revenue. So, one chart that I like to look at is, what's causing the ROE to go up? Either your cost is going down or your revenue is going up, or a combination of both. So for El Paso, the revenue was increasing. We've seen costs stay relatively flat until 2020, 2021 as inflation started to kick in. So when we break out the cost, majority of it is the transportation cost. The rest is depreciation, like you mentioned, interest. Those generally stay flat throughout the life. We see some variation, but they'll stay flat. The real cost that goes up is the transportation cost. So we've seen that in the last few years start to go up with El Paso, not enough to keep their ROE down, but it is a trend we're starting to see, and that might result in pipes being able to raise rates. If their costs continue to go up and their revenue doesn't match that due to inflation, due to higher G&A, you'll likely have a lower ROE. So it might get to the point where rate cases are actually a positive for investors in Kinder if they're able to continue to raise those rates.
Right. And that is often hard to tease out as well. ROE will typically degrade if their costs are going up and the revenues aren't matching it. But there can be problems with regard to that again, those projects may be throwing off very good ROE, but the costs of the traditional pipe may be increasing. Yep. And so it may be worth their pain to file a rate case even if the gross ROE for the pipeline is high, if that traditional pipe is not earning what they want it to be earning. So sometimes it should show up in the ROE, but it can be somewhat hidden in the ROE as well. So.
Yeah, and I'll just wrap up the El Paso point here is, so with the settlement, like I mentioned, as of this recording, it should be settled, and January 1st, 2023 is when the first rate cut occurs. So overall, they agreed on a 16% cut to max tariff revenue. So obviously not all the revenue like we've touched on. And what's nice here, and what I didn't have modeled, in my model, is they did over 3 years. So I'm starting to see this more and more where it's 6%, 5%, 5% into 2024, which as an investor in Kinder, it's a lot easier to swallow. A 16% cut to one of their larger pipes, you'd probably feel that in the quarterly earnings. 4% or 5% cut for a whole year, it's not going to, on a $7 billion company, it's not going to affect your earnings as dramatically. So I think that's a win for investors. It's a win for El Paso. Shippers maybe, who knows what their thoughts are there, but from my point of view, it's definitely a good result for them. And Kinder's been doing a great job at these rate cases. NGPL surprised me too. They got a pretty modest rate cut for how much that pipe was over earnings. So Kinder Morgan's been doing, in our eyes, pretty good with their rate cases. Did you want to touch on how you guys look at the overall industry? Because you guys probably cover some really small assets with some of your clients that we might not look at. So did you want to touch on the industry as a whole and how these rate cases have been going?
Sure. Looking beyond KMI, we do this across the industry, and you guys monitor this as well. It's just that, again, as you say, a particular shipper might be very interested in a small pipeline that on an aggregated basis is not very important. So we keep track of them all, and if you have interest in any particular one, you can contact us and we'll walk through that risk for your particular pipeline. Looking out, so basically we do the same type of monitoring you do. We monitor the comebacks and moratoriums and know which ones are coming up in the next couple of years, so people can keep that in mind. And then we also monitor the sort of a matrix of the ROE that the pipelines are earning, updated each year when they file their Form 2, and also the negotiated rate revenue percentage. So we look only at negotiated rate revenue percentage, like we talked earlier. We put those basically on a matrix, and if their ROE is above about 18%, we consider them at risk, and if their negotiated rate is below about 60%, we consider them, a target, not necessarily a target, but a potential rate case party. So, we can put all of the industry on that sort of matrix and see who's above about 18 and who's below about 60%. And again, based on that, you can then dive into what type of, how big the revenue is for those pipelines that are in that sort of category. On the flip side, as we talked earlier, there is an upside, I guess if you consider it an upside, in the sense that if a pipeline is currently earning a low ROE, they may be incentivized to actually file a rate case and raise their rates. And so that can result in a fairly substantial rate increase and revenue increase. It also means that as a shipper, you need to be aware of that. And if you're going to ship on that pipe for a long term, you might not want to be in that tariff rate class. So, there's also pipelines that are earning well below 10% and have very low negotiated rate contract percentage. So those would be the type of pipelines where the pain of filing a rate case may be worth it because they're no longer earning a return that's adequate for their investors. And so there are pipelines as well that aren't owned by public companies. And so obviously their owners care about that probably even more than the public companies do. So.
Yeah, I was going to ask, have you seen a trend in pipelines negotiating more contracts where they're trying to get their negotiated revenue higher because they realize the higher their negotiated revenue is, the probably less likely of a rate case, and if there is a rate case, the less of a hit they take, or is it staying pretty steady of mix between negotiated and not?
No, I mean, there are pipelines that you can see that are clearly almost signing only new negotiated rate contracts. So, that is a strategy that a pipeline will use when it's coming up on either a contract cliff or, a potential rate reduction. And so you will see that, and yeah, there are pipelines that will only sign negotiate or will insist that their shippers sign negotiated rate contracts. Now, a shipper can always refuse because that is what the max tariff means. Yeah. But if the capacity is particularly valuable, they might be able to extract sort of a negotiated rate. And they may be able to agree, again, on a levelized rate for a term. And the shipper may be willing to do that because they don't want to take the rate risk either. So.
Yeah, and you mentioned it there, and people might not realize, but you said the pain of a rate case. Right. because they're not fun. They take a year or more, and if you go through the FERC filings, they're filing with lawyers every single day, so I can imagine it's not cheap for them either.
No.
But did you want to touch on the process,
Sure.
just high level of what they have to go through?
Sure. So, yeah, I mean, I think the first thing to realize is that 99% of all rate cases, either Section 4 or Section 5, are going to end up settling. The actual process, the official process, can go on for 2 years or more, and so that is a long-term commitment and takes a long time, and then you throw yourself on the mercy of FERC to make a decision that's acceptable to both parties. So there's an incentive, I think, for both parties, the shippers and the pipelines, to reach some type of settlement. And so the previous rate case that went all the way through a hearing was El Paso in 2011. There's currently, as we're filming this, there's currently the second rate case that has gone through the entire hearing process, and that's Panhandle Eastern, and that's set for a decision supposedly tomorrow at FERC, although FERC has pulled it from its docket once before. So we're not sure that they're going to render a decision, but that's the second one. So you went from 2011 to 2022 without there being a full hearing. So that gives you some idea of how many settle.
Yeah, and you mentioned settle versus going all the way through. And just to clarify, when you say settle, basically the shippers and the pipeline can get together and agree on a rate cut at any point during the rate case. And as long as they have an agreement, FERC usually honors that, right? So that's why it's so much shorter, is if they say, hey, you don't want to be in a rate case, I don't want to be in a rate case, let's just cut the rate or raise the rate and get it over with. Right. Versus usually I'd imagine if FERC makes the decision, it's not going to bode well for the pipeline usually.
Well, because there's only two, I think it really ends up being more, can the pipeline and its shippers, there tends to be a breakdown just between the trust factors, I guess, that causes it to go all the way. I think, again, the incentive is to settle. People, neither party wants to take the risk of rolling the dice and knowing what FERC's going to do. So right. Sort of having the wild card of what will FERC do encourages both parties to come to a settlement. So the timing of it is, what we've seen is the settlement typically takes about 200 days to a year from the time the case is filed. El Paso that you talked about was about 211 days, but the shippers already had a cost of service study, which in a Section 5, just to roll through quickly the timing of a Section 5, when FERC issues the orders launching a Section 5, it gives the pipeline 75 days to file a cost of service report. And that's when the action really starts, because until the pipeline files that cost of service report, nobody really knows in detail what its cost structure is. El Paso's shippers had a benefit because El Paso, in a previous rate case and rate settlement, had agreed to file a cost of service study at the end of 2021. They got that cost of service study, and then FERC issued the Section 5 order like a month or two later. So the shippers already had a 75-day head start on the typical Section 5 shippers. In a Section 4 case, it works a little differently. The pipeline files it. They suggest that it goes into effect, the new raised rates go into effect 30 days later, unless FERC suspends that increase. And FERC almost always on the 30th day files an order saying we're suspending the rate increase for 5 months, which is the maximum they can extend it. And they send it to a hearing, but the hearing never takes place. What really happens is they appoint a settlement judge, and the settlement judge starts the settlement conferences that occur. And we track how many settlement conferences occur in each case. So again, for our pipeline customers, they can figure out how many settlements they might have to, how many settlement conferences they might have to go through. We track who the settlement judges are, so if that has any impact. But at the end of that 6 months after they file, the pipeline does begin collecting at the new rate. So therefore, a time period, they will be collecting at the increased rate. and then they will probably settle, like we say, probably 6 months later. And part of that settlement will be, what do we do with the revenue we've collected that is in excess of what we've now agreed to is the going forward rate. And so that refund sort of obligation will be part of the settlement discussions. And there will probably be some type of refund paid to the shippers as part of the settlements.
Yeah, and from our point of view, when they start raising those rates, when you look through a FERC form for the financials, they actually have a category. It's a provision for rate refunds. So they actually start putting it in a bank or a category because they know, they're like, here's the new rate, here's our old rate, here's what we're accruing. For how FERC reports total revenue is they actually take all the revenue from the different contracts less this bank of revenue. So generally, from our point of view, for a company, when they're playing this game and raising the rates, you won't see that come through the company's earnings. I've seen it happen once or twice where they call out higher rates, but generally they won't want to do that because they know they have to give it back, and if they have to give it back, they might miss on that quarter. So that's something that we look for, and so just because they raise rates doesn't mean the company will see that, and generally they won't put that in their earnings until the settlement's complete.
So that would mean they'd get a nice bump when the settlement's complete.
If it comes out positive, exactly.
So in most cases, again, in a Section 4, the rates do go up. Again, because of these comebacks that are forced upon a pipeline, sometimes there are Section 4 rate cases filed where the pipeline tries to justify an increase in rates, but they file for an increase, but then that settlement results in an actual decrease. So that's a possibility. But again, in most cases, the Section 4 case files for an increase, and the proposed increase can be high. I mean, it can be as high as like tripling their current tariff rate. So, but again, because most cases are settled, the settlement percentage ends up being somewhere in the 40-50% range, typically, of what they asked for. And so the actual impact, even if I ask for like a doubling of my rates, I may only get a 50% increase in my rates or a 30% increase in my rates. So again, when you're looking at what they filed for, don't immediately assume, oh great, they're going to have this new revenue stream for the next 20 years or something, because they will probably settle for something substantially less than what they filed for. And then in Section 5 cases, they almost always result in a rate reduction unless the pipeline does what is called filing a Section 4 in response to the Section 5. That's in fact what Panhandle Eastern did. They got Section 5'd, and about 6 months later they file a Section 4 and go on the offensive. So the best defense is a good offense. We think, again, when we're filming this, we haven't seen the final results, but based on the ALJ's proposed decision, I think that strategy is going to work well for Panhandle Eastern. I think they're going to end up with a rate increase. So they successfully launched an offensive and raised their rates, even though the shippers and FERC, when they launched the Section 5, thought their rates were already too high. But if they don't counter with that Section 4 offense, it really does result in a rate reduction, and some of them can be substantial, up to 25%. But again, keep in mind that's only on their traditional non-incremental pipeline system, and so it won't necessarily mean that kind of a revenue hit to them, because a lot of the negotiated rate revenue and maybe even most of the discounted rate revenue won't be impacted by that. So
yeah, look at the some of the charts that you showed me, and like Tuscarora and Iroquois, those pipes. Tuscarora feeds demand, in the California, Arizona area, and Iroquois feeds demand in the Northeast. So, these are some of the pipes that we've seen pretty big prints of cuts when you first look at them, above 20% cut, which is pretty high. Right. But Iroquois, they're mostly utilities on the other end, and utilities generally will sign negotiated contracts. They just want to secure gas for their customers. So, for Iroquois, generally, I know me and you were kind of joking, but they have such a high negotiated percentage that when they go through these rate cases, they're probably faster, and they're probably like, okay, we'll take a 20% cut because they know the impact to their revenue won't be as much. So it's definitely pipelines that have utilities behind them. That's generally our view are probably safer, because a lot of that is those utilities will need that gas. That's not like they want to go elsewhere. Versus a pipeline where you have producers or supply push, where they might have more of an advantage, and producers look closer at the rates because they can't pass them through to customers and things like that. So when you're thinking about assets that you invest in or look at, location and who the customers are is really important, and that's what we call out, and I think you guys do as well. Like, here's your customer mix over the last 10 years, and we can kind of call out when and if there is a rate case, what it might look like.
I think, and you hit on it, I mean, for a local distribution company, they just pass through the cost of not only their gas, but also the transportation costs. They pass it through to their customers,
Yep.
and they can't make a profit on it. And so really what they're focused on in negotiating with the pipeline is secure, reliable service, essentially. Whereas a producer, it cuts into their net back. Mm-hmm. So they care about the cost. So they will be a little more aggressive and unlikely to settle as quickly. And so there can be a tension there in the settlement proceeding between classes of shippers as well. Typically we see the producers form sort of an ad hoc group, and you see the LDCs sort of form an ad hoc group, and so you're often, as the pipeline, trying to get them all. It's like herding cats at that point. So trying to get them all to agree on what the rate reduction or rate increase should be. So with that, Zach, why don't we send it back to you, and you can wrap us up for this webinar.
Absolutely. So I know we went through a lot today, and these rate cases can get really in the weeds. And what we want to touch on is, if you've never heard of a rate case before, or you have and you didn't really understand, we want to give a high-level view on what the process is, how long they usually take, and really highlight what's important to look out for when you hear this in the news, or see something come across your computer. And really want to highlight is, give us a call. Gary or I, we work with these rate cases. Maybe you a little bit more on the regulatory side, but we work with them every day, and we know what to read, so you don't have to end up reading a 1,000-page report. We can give you the cliff notes and let you know what risk there might be for you, depending on if you're a shipper or a pipeline, or you invest in Kinder Morgan. That's one thing we highlight too, is we model assets for every midstream company on a cash flow level. So no matter what company you invest in, we can highlight what percent of cash flows these interstate pipes make up. So we can really tell you, hey, you invest in this company, their interstate pipes make up 0.001%. If you hear about a rate case, we're happy to go through it, but in general, don't sweat it when you see that come through the news. And on the other side, we can highlight the companies that do have a significant portfolio of these pipes that you should watch out for. On top of that, we have a full suite of fundamental supply and demand products across all the commodity suites. So, when looking at gas, it is important to know where the basin's going for these pipes as well, because longer term, that'll affect the ROEs and what the pipe's earning. So that does roll up into all these type of rate cases. Lastly, I'll plug our daily note. So we have a note that goes out every morning, just going over anything infrastructure. So it could be focused on supply and demand, it could be focused on a specific company. That's free to sign up for at eastdaily.com. I'll also say, Gary and I have worked together previously, and we've actually worked together with a mutual client or a new prospect that has a question on the investor side, but also wants to understand the regulatory side. I think one good one we did was the Permian egress. So there's a lot of pipes being proposed, and I went through on my side, what the egress looks like, when we'll need new pipes, and then you dug into an area that we don't focus on, which is the eminent domain, the land grabs, and you're really able to predict if the pipeline's going to come on or if they're going to be delayed. So that was an example of when we've worked together where, I tell our clients it's going to be constrained. There's 3 pipes proposed, and then you came in and said, here's the pipe that will most likely win. So right. You can reach out to Arbo or myself if you want to work with us or Arbo or both of us together. We've done that before, so just wanted to throw that out there.
Yeah. Yeah, and at Arbo, we cover a broad range of, as Zach said, of regulatory and legal issues and across all commodities and any type of energy infrastructure really. We will help you, and we can make it far easier for you, and we can be an extension of your team rather than you having to dive into all of this arcane legal and regulatory issues. And on a similar basis, we have a blog that you can subscribe to at goarbo.com, and it will keep you up to date on what we're thinking about within the energy infrastructure industry.
Yes, I think the video just wrapped up, and I think we'll kick it off with some questions here. And feel free still. We'll still take some questions if you have any that come up. Answer that, throw them in the chat at the bottom, and we'll try to get to them. So to kick it off, we have one question. Aren't negotiated rates considered an overall cost of service recovery? Gary, I don't know if you want to kick off an answer to that one.
Yeah, I mean, again, it depends on what the negotiated rate is. As we talked in the webinar, there are three real types, and it depends on how the negotiated rate contract came about. If it is one of those projects that FERC has ordered to be incrementally priced, really the revenues and costs of that project will be kept separate in the rate case. And so it would not be fair. For instance, as I mentioned in the webinar, at the end of a 20-year contract, let's say, on a project basis, that contract will be way in the money compared to the amount of costs associated with the asset that was built, that anchor shipper contract facilitated. It would be unfair to the pipeline to now roll that revenue into its overall revenue from the traditional pipeline, because they suffered the consequences of under recovery for the first few years, so they have to get the benefit of the over recovery. So those incrementally priced negotiated rate contracts will not be considered in the overall cost of service. Those incremental projects will be looked at, but again, most of them will be based on negotiated contracts. And so even if there's a mismatch in revenues, nothing will happen to that incremental rate. The other two types of negotiated rate contracts that we talked about, either I've agreed just on my traditional system to negotiate a rate to avoid a change in the rates, either from the shipper or the pipeline's perspective. Yeah, those revenues will be rolled in. There's a whole system about how much of that revenue should be counted in the revenue of the pipeline for purposes of the cost of service study. And similarly, then, any revenue from the third type of contract that we discussed, which is a low fixed cost, a high variable cost, or a variable cost that floats with the market, that would be rolled in as well. But again, those two types of negotiated rate contracts are not the usual. The usual are the incrementally priced, and those sort of just roll through the rate case. So they will not affect the overall revenue that is compared to the cost of service for the traditional system.
Yeah, thanks, Gary. I don't really have anything to add there. I think you kind of covered it. Jump to the next one. How will rising interest rates impact Arbo and East Daley's expectations around the ROEs that pipelines will be able to earn? I can start off with that one. Indirectly, interest rates will increase costs, but also we'll see the desired ROEs that the pipelines are going to want increase a little bit also, as they're going to demand, a little bit higher premium for that additional risk they're taking on there. Similarly, as we touched on in the webinar, with inflation, also, we may be seeing some rising costs and some higher G&A. And we may be seeing more instances of pipelines trying to file rate cases to, recover more and raise rates. I don't know if you have anything to add, Gary.
Yeah, I would just add, the interest rates themselves will only impact that part of the return that is debt. And so, yes, if a pipeline needs to go out and replace 3% debt with 5% debt, that cost obviously goes up. But again, they don't earn really any profit on that. They're just recovering that cost. So for them, that's not a benefit. It just means that they're going to have to maybe file a rate case when they wouldn't have wanted to, if they had been able to renew that debt at 3%. I think, as Zach put it, there is a risk premium associated. So if interest rates are 10%, you're not going to, people are not going to invest in equity for 11% or something. So as interest rates go up, there will be an impact on the ROE, but that will get filtered through the whole process of how ROEs are fixed, which is FERC goes out and, there's a whole battle of experts about what the market is demanding for similarly situated pipes. So that market demand will increase as interest rates go up, probably.
Yeah, thanks, Gary. Moving on to the next one. Have we looked into Southeast supply header, so SESH, is return and possibility of being forced into a rate case? I can answer from our side. I mean, we do monitor SESH, and that's something that we look at. We have the similar data and a view available that's very similar to what we presented in the webinar on El Paso. But right now, we're not going to get into specific pipeline details. If you do have those questions on specific pipelines, just reach out to us directly, and we'll be happy to work through those with you guys from East Daley's end. I don't know if you want to comment, Gary.
Yeah, I mean, same thing with us. I think we tried to lay it out in the webinar, the process we would go through, which is basically you would look at their overall ROE for the last few years. Is it in an over-earning or under-earning situation? And then how much of their revenue is negotiated rate? Because if a lot of it is negotiated rate, there's not going to be much risk of a Section 5. And if a lot of it is negotiated rate, there's probably no benefit for them filing a Section 4. So, you just look at those two factors, those two key factors really, to sort of assess the risk for a particular pipe.
Yep, thanks, Gary. Then we had a few questions in a similar vein. Gary, I don't know if you can tell us, will this webinar be available to watch again or share? Is there a place to download it?
Yes. Everybody that registered will get a link via an email, and it will be available for replay. So if you want somebody who didn't register and wants the replay, let us know. Or if you want to share the one you get, that's fine with us as well. Thanks.
Thanks, Gary. So we had another question. We did, I think we answered this in the webinar, but we can just gloss over it again. So what happens to the current revenues generated from a pipeline in a pending FERC rate case? Does the pipeline collect the current tariff and record a reserve to account for potential rate refund? Or how does that work?
Yeah, it varies between the Section 4 and the Section 5, and I do think we sort of covered it in the webinar. In the Section 4, when the pipeline files, they will ask for the new rate to go into effect 30 days later. FERC will almost always suspend that rate for 5 months, but then at that 6-month mark, yes, the pipeline begins collecting the new rate. But I think, as Zach mentioned in the webinar, a lot of companies sort of reserve a differential because that new rate is subject to refund. And so if the final rate that's agreed to is not equal to that interim rate that's been collected, the pipeline's going to owe a refund to the shippers. That refund is usually a topic of conversation in the settlement if the settlement occurs after that 6-month mark. For a Section 5, it's very different. A Section 5, FERC has no authority to impose a new rate until that new rate is established. So in a Section 5 proceeding, the old rate is collected until the new rate is fixed. Again, in most cases, that new rate is fixed via settlement. And so again, part of that settlement negotiation will be the effective date of that new rate. And if there's any refund obligation that, the pipeline wants to take on. because they've been perhaps over collecting. But all of that will be hashed out in the settlement. If it's not settled, literally the new rate cannot take effect until FERC issues an order confirming the new rate. So there would be no refund at that point.
Awesome. Thanks, Gary. We have a few questions kind of around timelines. So the timeline from a start to finish for an average, Section 4, Section 5 rate case. We did give some guidance around El Paso's. Is that an average rate case, would you say, or is there any?
Yeah, I mean, again, since most cases settle, the settlement range is typically from about 250 to 365 days, somewhere in there. So, you're going to see about a year before the settlement takes effect. And again, for Section 4, that means they might be collecting revenue at the proposed rate for maybe 3 to 6 months before the settlement kicks in. So, there can be a pretty good period there where the pipeline is collecting more. Panhandle Eastern, for instance, has been collecting, I think, the proposed Section 4 revenue for like almost 2 years now. So, to the extent that that rate is finally fixed by the order, there will be a differential between what they've been collecting and what the final order fixes it at.
Awesome. Thanks, Gary. Kind of in that same vein, we have some questions looking at comeback provisions and moratoriums. Kind of how do we know those timelines? And, it's typically like a 3 to 5 year, window between rate cases, it seems like. So I can take part of that and just say, when we read through these settlements and rate cases, they explicitly, part of that settlement is when the moratorium includes the moratorium and comeback provisions. And so those are usually explicitly listed out within the settlements. Like, for example, I believe El Paso's is in October 2027, I think, for when they are going to be in that again. I don't know if you have anything to add there, Gary.
Yeah, I guess the only thing I'd say is, you have to have read all of the settlements over the last 20 years to know this, I guess, or something. But the other thing is that it can be a sort of an early indicator of which direction people think the pipeline's rates are going. Because if the shippers are insisting on like a 2-year comeback or something, that may be an indication that the shippers agreed to the settlement rate, but think it's still trending down and they want them to come back in within a couple of years. If they both agree that it's a 5-year, nobody wants to go through this pain again for 5 years, it probably means they all agreed this should be the rate for a while. Let's not fight again. So the length of time can be somewhat of an indicator of, whether the pipeline thinks the rate it got was fair, or whether the shippers think the rate they got was fair. And so the longer that moratorium and comeback is, probably the fairer the rate was from both parties' perspective, or they would have insisted on a shorter time period.
Yeah, that's a good point. And also in that comment period for after the settlement's proposed, I mean, you can also often see that some of the shippers will be, seemingly happy and put out statements for the settlement, which kind of can, key into that as well, that all the parties are satisfied. So we'll jump to another question. So this one's specifically for you, Gary. You've written a lot about the politicalization of FERC over the past several years. Does any of that dynamic influence rate cases in your opinion?
It has. More probably on the oil side of things than on the gas side of things. But during the Trump period, there was some perception that FERC was putting its thumb on the scale, trying to change the methodology for calculating the ROE to drive that ROE higher. it has settled back down, I think, to now there is a new method for how to calculate the ROE, but I don't think either side views it as a thumb on the scale, and they seem to be accepting of the new method. So right now, there's probably not much of a politicization of the rate case. Although I think Panhandle Eastern would probably disagree with that. Again, FERC, when the Tax Cut and Jobs Act took place in 2017, FERC had a bunch of rules about MLPs and how they can recover, and it was a mess. But in the Panhandle Eastern case, they sort of split the decision. They agreed that Panhandle Eastern could write off a bunch of its what is called accumulated deferred income taxes, which drives up their rate base. But then they also said that they have to share some of the what is called excess deferred income taxes by passing that back to the ratepayers, to the shippers. Panhandle Eastern thinks that's sort of I think, a political settlement. And so I think there is still some of that to be hashed out, but I think at this point the political aspects of the rate case are pretty mild right now.
Awesome. Thanks, Gary, for that insight. And I think that wraps up our questions. We'll give it one more minute, and then, yeah, I mean, if we didn't get to your question, we'll follow up with an email. Send us emails directly if you guys have any questions, for example, on those specific pipelines like SESH or whatever you guys are interested in. And with that, I don't know if you have any closing words, Gary?
No, just as long as people know the replay will be available. So
Yep.
That's it.
Yep.
Thanks for coming.
Yep. Thanks, guys.